Good evening. It's Peter from the Weekly Options Room at ShadowTrader.net, and this is kind of a post-FOMC analysis of what's going on. Kind of like, we'll call it the State of the Union post-Fed. And if anything, I think it's a good lesson, for lack of a better word, for people not to get sucked in on bullishness of the Fed, because it very often just comes right back down, and that's what you're seeing now. You see here, there's your Fed bullishness, right? This is the 2 p.m. candle, Eastern time. Makes perfect sense, right? This is the hour that it spent ripping higher, went higher here, and look what's happening now, about 80% retracement, giving it all back. So more than likely, if you come to here and you have 100% retracement by tomorrow morning, which you may, you are probably going to move lower. The odds are you're going to go like this. And these lows here, it should be noted, are weak because they have reference, right? They're kind of equal. And when you look at that on the profile, you can see that really clearly because it's actually 3 sessions, I believe, because there was some overnight there as well, right? Look at the area here, how many sessions there are actually all in the same area, which is essentially just weakening these references, right? There's 1, 2. This overnight, you can barely see it because it's really thin here, but that's actually right to there. And then you have the RTH of Wednesday itself. So what do you think is going to happen on a test of here, right? This area is weak. We call this a weak low because its support has been weakened by multiple tests. So keep that in mind, that there's potential to go lower. And that essentially is the whole, I think, key to the whole market of what's going on right now is the fact that you essentially are in a relatively large balance area. If you look at this daily chart here, just on the ES, I mean, you really haven't moved. And this was the sort of dynamic that I was addressing in the weekend edition last weekend, if you're watching, talking about how I always think that it's problematic whenever a market advances and it only makes incremental highs, or if it advances on like kind of a 1 day up, 1 day down, middling bar, slightly higher, doji, higher but with a topping tail, 2 days down, then it negates the whole thing. Do you see what I'm saying? It's not a definitive rally. There's nothing clean going on here. So what you want to be on sort of on alert for is the fact that any balance area can always break in either direction. You would think, and as I thought, that it should be up since it's consolidating the up move, but it doesn't have to be. Let's just remember that. Today's Fed action was kind of funny in that people were saying it was like a hawkish cut, right? That they cut, but there wasn't much confirmation that they would do anything again in early 26, and we know there's going to be another meeting in January, right? So we'll see. Just kind of think about that. And if it is lower from here, the other thing you want to be thinking about also is that it's never really overly bullish, I don't think. Or what it does is it kind of sets the stage for a liquidation break when you're just riding the moving average like this. You see how this is just riding it, how almost all the candles are interacting, and then boom, you get a liquidation break. Whereas this is much more healthy when it rises up above it. And this is a similar situation where you're just sort of riding up above it. So this is all kind of what I'm thinking as we go, as the market moves forward. And in all of this time as you've been moving, value really hasn't shifted much. It's really, again, just one big balance area. And yesterday, or I should say today, I apologize, today I'm speaking to you late in the evening on Wednesday after this Fed action happened. This is a perfect example of how market profile theory is just so valuable in that you closed relatively strong and you know that you came all the way up to here where there's this resistance area and you actually took it out by a little. There was obviously on the Fed you get strong action and it's natural to back off a little bit into the close, right? But not so much to give back another huge chunk of the move like that. But regardless, as we closed here, you always want to pay very, very close attention to whether or not value and POC are following price. And in this case, it didn't happen at all. Now, obviously, the Fed is at 2 in the afternoon, so there's only 2 hours left. But a stronger market that would have been committing more volume at higher prices up in here would have expanded this value area higher and would have made this yellow area really look more like this, where it would just expand up higher like this. At the very least, closer to the settlement. I don't like to see a settlement like this outside, far above the value on a bullish day and not have the value follow. And at the same time as the value didn't follow, right? You see how the value areas have essentially been unchanged? The fairest price to do business, where most people traded the most futures contracts today on this Fed Day Wednesday, is right here. So it's not surprising this is being drawn to it. You'll see, obviously you're gonna watch this video early in the morning on Thursday morning, because that's when it's gonna come out. But you'll see that overnight that level is going to get tested, and it's probably going to be in play tomorrow. And if we open somewhere over here below that level, understand that all of this is overhead supply. You need to open up here and put this stuff in the rearview mirror in order for the market to not sell off early. So I wouldn't be surprised if you sell off here, you get some sort of a dump, or even if you rise a little bit, you're going to find resistance here, where the POC is where most of the people traded. So it's something to keep in mind. It's very, very important, because price moves faster than value always, right? Because value by nature is a measure of time spent or volume committed. So it can't ever move as fast as price. But when there's a divergence like this and value and volume don't follow price, it's an important piece of market generator information to add to your narrative, as I think you should do. Okay. Last but not least, I will just go over the top 4 sectors in the S&P, because this was also something that I discussed in detail in the weekend edition. If you recall, the last weekend's weekend edition was called the 4 charts that every trader should know. And those 4 charts are essentially XLK, XLY, XLC, and XLF. So financials, communications, discretionary, and technology. And the reason for that is that that's literally 70% of the market. And it's not surprising that they're giving lots of mixed signals in that. For instance, let's look at this technology. Technology is generally going to look kind of like the S&P, because it's like 36% of the market. But again, notice the incremental highs and just kind of riding the 8. And the second sector in terms of weight is financial. And it looks good. I think it looks good. These highs are a little bit, higher than incremental. It took out this level and it closed strong right at that level. And it looks like it's chugging up to there. So it looks pretty good, right? And if you look at XLY, I think it also looks pretty good. But this one's really interesting to me in that I would think that if something negative were to occur tomorrow, or bearish, I should say, is much more accurate, and you took out this low of Wednesday, well, not only are you going to have the overhead supply of Wednesday, but all of this bullish action in the late part of the rally, and usually these are the more unsophisticated players that are active in here, they're all going to be wrong, and that's all going to be a flip to kind of dump, right? So that's XLY. Let's look at XLC finally. The communications looks similar, but it was not as strong. It's not. I don't think it's as strong as the discretionary, because look at the relationship to this high. It didn't get anywhere near there. But the point I'm trying to make, I think the main takeaway from looking at these 4 sectors is, they're all cautiously bullish, which kind of makes sense because that's what the market's been doing, correct? The market is essentially just cautiously bullish, and that's pretty much all that's been going on, right? You've had this slow grind to the upside, so it makes sense that these 4 sector charts that make up 70% of the market would look that way as well. Okay, so that's it. I'll leave it there. And, like I said, just kind of cautiously, I wouldn't even say cautiously bullish. I'm just cautious. Like right now in my own advisory in the room that I run, we have very little on. We've got 2 Coinbase plays because we feel that they're tied to crypto. And we put on a gold play today. We put on a spread in AEM because I feel that it's going to follow the metal. And I like the reversal bar here. And I like the second higher low. So here's a low, and here's one, and here's two. I like the second higher low. And I thought the trajectory is going to be here to the downtrend line, similar to the trajectory of GC, which is also going to be going to a downtrend line, correct? If you look at GC here, you can you can draw one just like that. And look at how these levels here match up, wherein you've got peak, 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 right? These peaks right here, and they're just right under there. They're actually forming the trend line because this is point number one, and they're forming it. So I think there's potential that you get a movement of this up here, you know, closer to the all-time high. I mean, I remain bullish on gold. I think it's literally one of the best trades out there. And you know, if the stocks aren't working, this just is, like, over and over. Whether it's just for buy and hold or the covered call play that I do, or selling puts or whatever, I think it kind of should be in everyone's arsenal at the moment, because you have to be kind of trading in what's the spirit of the time. You know, what's happening right now. And certainly, nothing's going to happen. Trust me, nothing's going to happen in terms of the dollar strengthening or the United States getting their act together. You know, whatever the trillions in debt, it'll be more in 2026, and it'll be more in 2027. And I have zero faith in that ever being corrected. It's going to get worse and worse, and the dollar will continue to be devalued. And this is the trade. You know, it's probably $5,000 to $6,000 gold by end of 2026 or into 2027. Okay, but anyway, that's kind of a digression from what we're talking about, but hopefully it's helpful. Okay, that's all. Hope you have a wonderful Thursday, and I will see you all on the weekend edition.
Hey, this is Peter from ShadowTrader.net, and I just wanted to thank you for watching this video. If you enjoyed this content, please hit the like and subscribe buttons. And if you'd like to trade live with me every day in my weekly options advisory, then check out the link in the description below. I wish you good trading, and I'll see you in the room.